Deion Sanders, NIL payments and opportunity costs. This is Ken Boyd with the Accounting Accidentally account on Substack, Accounting Accidentally, Substack.com. So, Coach Deion Sanders has his Colorado Buffaloes off. They're actually off to a 3-2 start. They've lost to Oregon and USC. And the quarterback is Deion's son, Shedeur Sanders, who's considered a first-round NFL draft prospect should he go pro after this year, which is one of the points of this post. But with money from NIL, name, image, and likeness that players can now earn in college, he might not go pro for another year. And this boils down to a question about opportunity costs, which I'll get to in a minute. So Shedeur Sanders has two options. NIL payments. Several sources estimate that given Colorado's success and Sanders' talent, he could make $10 million during next year's college football season. He may also be the number one quarterback prospect going into next year's draft, not 2024, but 2025, which increases his first NFL contract substantially. So how much is it? So what's the difference between the number one player taken, maybe in 25, versus someone who's drafted lower in the first round this year, which would be spring of 24? According to Yahoo, the number one pick earns a contract of roughly $41,217,000 in value, with a signing bonus of almost $27,000. Well, what if you're drafted 10th? The total value of the contract is only about 22.6 or 14.2 million less than the number one pick. Now, there's another variable, which is the risk of injury. Fortunately, NFL prospects can buy insurance policies based on their potential NFL contracts and where they might be drafted. So let's focus on Sanders' opportunity cost because it applies to business too. So here are his choices, assuming that he would be the number 10 pick in next year's 24 draft. Well, he could stay in college another year, earn $10 million maybe in NIL payments, become the number one pick of the 25 draft. He gains $10 million plus the $14.2 million increase in his contract value from the NFL. However, if he gets injured in college, he runs the risk of getting an insurance payout, but never plays in the NFL and never gets a contract. So with that in mind, what if he was to leave the NFL after this season? He's the number 10 pick, let's say. He earns a $22.6 million contract. He gives up the $10 million in NIL for next year, and he avoids the risk of getting injured in college next year, which would mean losing an NFL contract completely. So a really tough decision now that players can earn NIL money in college. And this brings us to opportunity cost in business. Opportunity cost is defined as the potential revenue gain or the cost savings lost and the profit that you give up by making one decision rather than another. It's important to remember you can have a profit from more revenue. You can also have a profit from saving costs. So why do business owners have to make this decision? Because everything in business is finite. Limited capital, certain number of employees, only so much time. You can't do everything, so you have to carefully think about what you do choose because you have to give up something. And here's an example. Sales mix. Sales mix refers to the percentage of total sales each product represents. Large manufacturers and retailers may sell hundreds or even thousands of different products. So let's say that you manufacture baseball gloves and that you have two models, a fielder's glove and a catcher's mitt. Here are the stats for this fielder's glove. $100 sale price less the $60 cost is a $40 profit. If we take $40 divided by the sales price of $100, we get a 40% profit margin. The catcher's mitt sells for $135. The costs are $85. The profit is $50. 50 divided by 135 is 37% profit margin. So to make an apples to apples comparison between products, businesses often use profit margin, which is defined as the percentage profit you earn on each dollar of sales. And you'll note in the example up here, product with the higher sales price, the catcher's mitt, is not the most profitable. It's priced higher at 135, but it only creates a 37% profit margin. So why not just sell products with all the highest profit margins? Because you lose the opportunity to sell other products to the same customer and generate more total sales. And this is why the big box stores like Walmart, Target, and online like Amazon sell so many products with a larger selection the chances of a customer buying something increases. And over the long run, the mix of large and small profit margins comes out to a pretty decent profit level. So that's food for thought. Remember that you can find other articles that I write and talk about at accountingaccidentally.substack.com. Thanks.